Thanks, Tuesday, and welcome to the Flagship Harbor Market Observations Call for the week of January the 17th. Just a reminder, this replay is for advisory use only. I trust everyone enjoyed the long weekend. Markets closed yesterday in honor of the late Dr. King. And speaking of markets, a little choppy this morning. That's coming after 2 weeks of fairly solid gains. Year-to-date, S&P up over 4%. I've actually seen a modest rally in bonds as well. And the catalyst for that appreciation has been progress on inflation. Last week, we got December CPI data, saw the headline rate fall to 6.5%. That was slightly better than expectations. Keep in mind, down from north of 9% that we all felt in June of last year. Core CPI in line with expectations, not as much progress as certainly would have liked to see. Nonetheless, though, that sort of spurred the hope for consensus that the Fed will now slow their pace of future rate hikes and in turn engineer a soft landing. For my seat, I can't say I'm necessarily surprised with the recent rally here, but I do think there's a little bit of a disconnect between fundamentals. When we think about growth, GDP certainly starting to show some signs of slowing. We saw that with some fairly negative leading economic indicators. China just came out, announced a 3% GDP print. That is significantly lower from where they've historically been, obviously as a result of their zero COVID policies. Also, if you look at a lot of the ISM data, that is trending in the wrong direction. As we then sort of think domestically, last week we kicked off Q4 earnings, heard from a lot of the banks. Not only are those folks very in tune with overall impact on the market, but have a unique insight into customers, into consumers. When you think about saving rates, spending rates, investment allocations, and that offered not only a fairly uninspiring start to the earnings season, but consensus from a lot of those folks was sort of a base case of at least a mild recession. Now, we've even started to see a number of banks start to set aside capital to prepare for any loan losses. When we think about the inflation story, yes, certainly following. Obviously, the stickier services piece hasn't made as much progress as I think some of the excitement in the market would suggest. And if we think back, Fed time and time again reiterated their goal of 2%. They obviously aren't going to get remotely close to that without any meaningful progress on services. And so as we then think about how that translates to rates, expectations are for another 25 basis points in February, 25 basis points in March, then likely expect the Fed to hold. Where I think there's a really big disconnect, a lot of pundits come out, expectation is higher for longer, likely stay in that 5% range through year end. Mark is actually pricing in a 50 basis point rate cut by the end of this year. And that's something, honestly, I just don't see. If we think about what would result in a 50 basis point rate cut, that would have to be inflation, falling significantly, well over, 50% from where it is today. Realistically, just don't think that's possible. Or secondly, if the Fed did come out and cut by 50 basis points, that would likely be in response to what is a very, very significant recession. Obviously, the latter is not an environment where you'd want to be long risk assets. And when I think about just overall conditions, for tactical investors, not sure this is necessarily the time that I'd want to be chasing returns. I do still think there's something to be said for a more conservative allocation, one too that also starts to nibble a little bit on non-US markets that have much more favorable valuations and actually fairly compelling growth rates as well. On the geopolitical front, one item that hasn't necessarily gotten nearly as much press as I think it probably deserves, Treasury Secretary Janet Yellen over the weekend came out, indicated that the U.S. Would hit its debt limit on Thursday. Therefore, they then enact the extraordinary measures, allows them to continually borrow, likely to take us through some point this summer, early fall, before a deal would have to be created, meaning two parties come together in Congress, agree in order to raise that debt ceiling. Otherwise, we'd likely be looking at default. And with that, if history is any guide, a great deal of volatility to come with it. Again, very surprising where we have still so many unknowns ahead of us to see markets rallying here to kick off the new year. As we look at the week ahead, do get some additional inflation data, PPI. We'll see if that confirms trends that we saw in the CPI report last week. Get retail sales. Obviously, that's going to give us a great bit of insight into consumer behavior. Are they still going out, still continuing to spend? Obviously, if folks are worried about losing their job or going into recession, you typically see those spending rates curbed. Also get some housing data. Again, that arguably one of the stickier pieces within services has been real estate. We'll see how that trades relative to what has been fairly uninterrupted prices as of late. And then lastly, World Economic Forum is hosted this week where we have billionaires, celebrities, world leaders gather in Davos to solve all the world's problems. Nothing especially unique coming out of that conversation. Obviously, focus is on how do we curb inflation globally, topic not new to anybody. And then on a separate note, winner of the 1.35 mega millions, that winner resides in Maine. First time ever a winner came from the Pine Tree State. So kudos to them and anyone in that area. Be on the lookout for clients that may need a new advisor. That's all for now. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.